In this presentation, we will take a look at partnership income allocation. For more accounting information and accounting courses, visit our website at accountinginstruction.info. The allocation of income to the partner capital accounts is one of the key differences between a partnership type of accounting and a sole proprietor or corporation, and therefore one of the areas we need to focus in on when dealing with a partnership. In other words, the question is, how do we record or track the income that has been earned to the individual partners? In other words, the partnership accounts can represent their share of ownership within the business. How are we going to allocate our income to the partner accounts and show then their share of ownership? We could do this with a table format, or we can do it with journal entries. We'll do it both ways here. It's always nice to have a trial balance for us to look at and see what we're dealing with when looking at the accounting process. So we got the trial balance here. We got the assets in green. Then we're really focusing in on the equity. And so that's why there's going to be a much smaller trial balance than we might see typically. But we're focusing in on just allocating our net income here. Then we have the income expense accounts, which would be revenue, and then the expense, cost of goods, and wages, just to show us a couple expense accounts to see the net income calculation being the sales minus the cost of goods minus the wages. This is the net income that we're in essence needing to allocate. We will need to allocate this net income. Note that the unbracketed numbers are positive numbers, the bracketed numbers are negative numbers, and therefore this 0 represents the fact that the debits equal the credits. The debits being non-bracketed, the credits being bracketed. Therefore, we are in balance here. We have net income of $80,000. We can see also from the trial balance that we have 3 partners here. We've got that. We can see that from the capital accounts. We've got the C capital, that's our partner, name is C, and then X and then S capital accounts and their related withdrawals accounts. So with a partnership, we will have multiple capital accounts and multiple draws accounts as we track the individual partners' activities as to the allocation of their earnings and the draws that those individuals partners are taking from the business. Now, what we're doing here is we're trying to get this $80,000 to close out. So we're going to do the closing process and allocate that net income to the proper capital accounts. We'll do that with a journal entry. We'll also do it with a table here. Now, with our table, we're going to have a more complex scenario to show the different types of way that we can allocate the net income. The partnership format of organization is very flexible with regard to the allocation of net income, which is great, with one of the benefits of a partnership. So we can decide, for example, if one partner, if C, is doing a lot more work in the partnership than the other 2 partners, we can set up our partnership agreement to allow C to get some type of salary benefit, to actually pay them more, not in terms of wages, but income allocation at the beginning in order to compensate for the more time that's being put in. If, on the other hand, we have someone else that puts in a larger amount of a capital investment, in this case, C, looks like actually X here has put in more money and retained more money or more assets into the business. And therefore, they should get, we could reason that we would want to give a bigger allocation of the net income. We can do that with certain types of partnership agreements. And so there's more flexibility for that. We don't just have to have a 50-50 type or an even split or any kind of ratio type of agreement. We can get more complex than that. So here what we're going to do is we're going to have a salary allocation, and then we're going to have the investment at 10% of the capital investment. And then we're going to allocate the rest evenly. So remember that the easiest way that we can allocate this 80,000 is we could say 80,000 divided by 3 and allocate a third to each partner. But that wouldn't necessarily reflect if the partnership wasn't even in representation, meaning one partner puts more money into the business possibly for investment or puts more time into the business. We can get to these other types of allocation methods. We will use all 3 here to show an example of all 3, the more complex type of allocation method here. And that's going to be the fact that we have a salary allocation followed by the capital investment allocation, and the balance shared. This information would be in the articles to set up the partnership, and if it were not, then it would be a 1/3, 1/3. It would just be assumed that it would be an even allocation between the partners. So given this information, we're going to first look at a table. So we'll start with that net income. That's what we're going to allocate out. And then we're going to say the salary is just given. That's just given in the contract, meaning we're saying whatever we agreed on, we're going to pay whatever amount of net income first out in terms of a salary. It's important to note that although books will call it a salary allowance, and we typically call it a salary allowance, it's not net income. It's not salary in the sense that we're going to have to pay with taxes on it in terms of payroll taxes. It's an allocation of net income, which we're giving as if it was a lump sum like a salary. So don't mix it up with payroll. This is not going through payroll for this format. It's just going to be a part of the allocation. So of the 80,000, we're going to allocate 4,000, 3,000, and 8,000 to C, X, and S respectively for a total of 15,000. So then if we total that up, we've got 80,000 and the 15 leaving just the 65 left. Of that 65, we're going to allocate based on our second tier, which is whatever capital investments was in there at the beginning of the year. So for that, we're going to say that whatever the capital investment was at the beginning, which we're going to say here was our original capital accounts. So for C here, we're going to have the 144 times 0.1. That's going to give us that 14.4. And then here we're going to have the X's capital account at 216 times 0.1. Gives us the 21.6, and so on and so forth. For S, 120,000 times 10% gives us the 12. So that was an agreed upon number in our partnership agreement to incentivize partners to invest and leave some of the investment in the company. If done so, they'll get a higher allocation of the net income. So of the 65,000, now we're allocating 48,000 at 14.4, 21.6, and 12,000 respectively to C, X, and S, leaving us with 65,000 minus 48 of the net income. Remember, we're allocating net income. We have 17,000 left. That 17,000 then, we're going to allocate evenly. Whatever's left over, we're just going to divide it by 3 and allocate it evenly between 3. So 17,000 divided by 3, 5,677 about. So that's going to be our allocation, and that'll bring us down to 0. So our balances then, for C, we got 4,000 plus 14.4 plus 5,667. And let's do that with a calculator. 4,000 plus 14.4 plus 5,667 gives us the 24.67. So that's going to be the amount of this net income allocated to C's capital account. And then we've got X capital account, the 3,000 plus the 21.6 plus the 5,667 gives us the 30,267. That's what of the net income of 80,000 that's going to be allocated to X capital account. And then we've got S, which had the 8,000 wage allocation, just an allocation, not salary, not wages, not part of payroll, plus the 12,000 plus the 5,677 gives 25,677, and that's going to be the amount allocated of net income to S, for a total of C's allocation 24,067 plus X 30,267 plus S 25,667. For that 80,000, it's off by rounding $1. So that's the allocation of this 80,000, this net income, how we're going to allocate it. And note the flexibility we have there in this allocation method. So if we go through this, then we can say, what will the journal entry be? We're going to close out the account just like we did in the closing process if it was any type of organization, meaning we're going to close out the revenue accounts to the capital accounts. Note that you may not always see this process when you see a partnership type of problem. They may just reference net income or even the income summary. And if you don't know what the income summary is or what it represents at this stage of allocating, then we won't understand what to do. So we're going to go through the full closing process. And that means that as of the end of the time period, we had net income of 80,000, consisting in this case of sales, 150,000, minus the expense, cost of goods sold, 60,000 minus the wages of 10,000, giving us that 80,000. We're going to close this out. This is a credit. We're going to do the opposite thing to it, a debit. And then the other side of it's going to go to the income summary. So that's closing out the sales half. So if we post this, we're going to post this sales over here, 50,000, 150,000 credit. Then we're going to debit it, making it go down to 0. And then the income summary starting at 0, going up with a credit of 150,000 to 150,000. So we basically just closed out the balance sheet account of sales and moved that balance to the income summary, our holding our account, our temporary account. We're going to do the same thing for the expenses now. Here's the representation of the whole thing. We can see that this is now 0. We still have the expenses on the books. We need to reduce the expenses. So to do that, we have 60,000 here. It's a credit, it's a debit on our trial balance. We're going to do the opposite, a credit to make it go down. And then we've got the 10,000 wages expense. It's a debit on the trial balance. We're going to do the opposite thing to it, a credit to make it go down. And then we're going to debit something that will be the income summary. So the 60 and the 10 is the debit of 70,000 to the income summary. So if we post this then, the 60,000 here, we're going to post that first. It's going down by 60,000. This is a debit. This is a credit, taking it to 0. Then we're going to post this 10. This is a debit. This is a credit, taking it down to 0. And then we'll post the income summary. We have a credit of 150,000. We're going to debit it, leaving us with 80,000. So what we've done now is move the net income from the income statement accounts to this new account, this holding account, this account called income summary. So this 80,000 was our original net income. It's 70,000 here because we closed out the 0, but it was 80,000. We moved the 80,000 over to the income summary. That, of course, the result of these two journal entries, the one closing out sales and the one closing out the cost of goods sold. It's important to note that many problems might just start here. And again, they're probably a lot of times not even giving you a trial balance. So what's going to happen is they may just say, the income summary account before closing out to the capital accounts has 80,000 in it. And that means that there's net income in the income summary account, and we need to allocate that to the partner capital accounts in accordance with the partnership agreement. So that's what we're going to do now. Now we have our table up here that already has this allocation. We've already done the work. So all we have to do is allocate this out now. If it was a sole proprietor, note how easy it is. If it's a sole proprietor, we just move that 80,000 to the one capital account, the one owner. If it's a corporation, then it would be easier still, or easier than the partnership in any case, because we would just move it to retained earnings, because all the partners are pretty much the same, and therefore they have the same claim. We don't need to allocate it to any individual owner, any individual shareholder. Here, however, we need to allocate it in accordance with the owners, the partners, because their allocation differs. So that's the most complex component, is that tracking of the individual partners within a partnership. So we're going to do this now. We're just going to say that the income summary is going to go down. It's got a credit balance in it. We're going to make it go down, doing the opposite thing to it, a debit. And then we're going to credit the C capital account in accordance with C's worksheet number here, 24,067 that we came up with. And then X's capital account for the 30,267, and then S's capital account for the 25,667. That, of course, adds up to the 80,000. So we're just allocating it to the proper capital accounts. When we post this, then we're going to take the income summary account here. We're going to reduce it by this income summary debit and take that down to 0. Then we're going to post the capital accounts. We got C capital account here, C's capital account up here. Note it's a credit balance in the capital account. We're going to increase it with another credit by doing the same thing to it, bringing the balance up to 168.67. Note what the capital account is here. It's basically a claim by the owners to the assets minus the liabilities of the business. So this is tracking what this individual owner has in a sense in the business. Assets minus liabilities is the equity section. This is this particular portion of that equity section. So then we've got the X's capital account, 30,267 allocated here. We have a credit starting at 216,000. Then we credit the 30,267, giving us a total of 246,267. Then we're going to credit the S's capital account. So they started out at 120,000, crediting it 25,666, bringing the balance up to 145,666. So when we see it all put together here, we can see these are the new capital account balances. The income statement is closed out to 0. The income summary is now at 0 as well. Now what we need to do is close out the withdrawals. So we got to close out the withdrawals, and note that the withdrawals will not tie out to necessarily, almost surely not, tie out to whatever the percentage is for the allocation. In other words, if we were to say that these were all even partners with a 1/3 allocation for the net income, that doesn't apply to withdrawals. They can withdraw whatever they agreed upon to withdraw. The withdrawals are not dependent on the income allocation, and therefore the allocation or the totals within the capital accounts will not necessarily match what the income allocation are. So even if we had like a 1/3 even allocation, the capital accounts are not always going to be 1/3 even allocations, because the owners could have put more money in than a 1/3 allocation, even though they agreed to a 1/3 profit sharing, and or the owners could pull out more than each other's owners. They could pull out a different number because the withdrawals have nothing to do with the income allocation. So just note that these ending capital account numbers will not necessarily be in accordance with any type of profit sharing percentages. So now we're going to do that component. We're going to close out the withdrawals. So to do that, we're going to say C's withdrawals, 18,000. That's a debit balance. We need it to go to 0. These are temporary accounts. This is similar to any closing process, except for now we have multiple draws. If it was a corporation, we'd have dividends as a similar type of account. For a sole proprietor, we would just have one draws account, one withdrawals account. So then we have the capital account being debited, which will decrease the capital account, which makes sense because we're lowering the amount that's going to be owed to C, kind of like a liability account, as if C was a third party. We're lowering how much the business owes to C because C took some money out already from the company. So then X, same thing. We're going to take this 38,000. It's a debit here. We need it to go to 0, so we're going to do the opposite thing to it, a credit. Then we're going to debit the X's capital account by that same 38,000, bringing that balance down. We will then do the same for S, crediting S 24. It's a debit balance. We're going to make it go down and debit the capital account. So if we then post this out, then we're going to say that C's got 18,000 here. It's going to decrease the capital account because this represents the amount C withdrew from the capital accounts, taking the balance from 168,67 down by 18,000 to 150,067. We then have the X's capital here. So that's going to bring the balance from 246,267 down by 38,000 to 208,267. Then we have S's capital account starting at 145,666, going down by 24,000 to a balance of 121,666. And then we're going to remove the draws. So here's C's draws, started at 18,000, goes down by 18,000 to 0. X's draws starting at 38,000, going down by 38,000 to 0. And then S's draws starting at 24,000, going down by 24,000 to 0. So this will, of course, leave us then with all the income statement accounts at 0, so sales and expenses, the income summary account at 0, and now the withdrawals accounts at 0, and the capital accounts now then representing the total equity. If we add up the capital accounts, they'll line up to assets minus liabilities. In this example, we don't have any liabilities, but we can see that these numbers here, what the company has, assets minus liabilities, will equal the equity section. The income statement has been removed or closed out, and therefore these numbers for each of the capital accounts represent at this point in time what is owed to the owners. Note that what is owed to the owners could differ from these actual numbers if you liquidate the company, because, for example, we may not get $10,000 for the merchandise if we sell it. But these, in theory, represent the value of the company to each individual owner of the company, and they will not be in accordance with the profit sharing agreements per se because of these withdrawals, because of differences in the amount that could be invested by each individual owners. For more accounting information and accounting courses, visit our website at accountinginstruction.info.